Today, we are diving into one of the most powerful and maybe one of the most misunderstood strategies in real estate, the BRRRR method. It's an absolute game changer for building a huge portfolio. But you know what? There's one super common mistake that can stop you dead in your tracks. Let's get into it.
So, what is this funny-sounding acronym all about? Well, BRRRR stands for Buy, Rehab, Rent, Refinance, and the most important step of all, repeat. The key thing to get right away is that this isn't a one-and-done deal. It's a powerful cycle that's meant to be used over and over and over again.
All right, here's our game plan. We'll start with what the method is, then we'll walk through the 5 essential steps. After that, I'm going to reveal the #1 mistake that trips up so many investors. And finally, we'll see exactly how this plays out with a real-world comparison between a flipper and a long-term investor. So what's the big picture here? A lot of people think BRRRR is just a fancy way to flip a house for a quick buck, but that's not it at all. The real goal is to build a long-term, wealth-generating engine. The real magic of BRRRR is in this loop. You buy a property, you force it to be worth more through a renovation, you pull your original cash back out, and then, this is the secret sauce, you do it all over again. You're basically recycling the same pile of cash to buy property after property. Okay, let's get into the nitty-gritty. We're going to break down each of these 5 steps, because if you mess up just one of them, believe me, the whole strategy can fall apart. So here they are, the 5 steps. I want you to think of this like a chain. Every single link has to be strong. If even one link is weak, the whole thing just breaks. So let's look at each one, and we'll start with the most important one of all, the buy.
Everything, and I mean everything, starts with buying right. This isn't about falling in love with the house. It's about finding a property that's undervalued. The source material says it perfectly. It's always about the math. The numbers, your purchase price plus your rehab costs, have to make sense on a spreadsheet long before you even think about making an offer.
Next up, the rehab. And here's the golden rule. You have to know what your renovation is going to cost before you buy the place. This is where so many people get torched, especially right now with labor being tight and supply chains all over the place. If you blow your rehab budget, you can kill your entire profit right then and there. Step 3 is renting it out. Now, this isn't just something you think about at the end. It's part of your initial math. You absolutely have to know what the property will rent for before you pull the trigger on buying it. Getting a tenant in there is what officially turns the house into a cash-flowing asset, and that's exactly what a lender is going to want to see for the next step.
And now for the part everyone gets excited about, the refinance. This is how you pull your original cash back out of the deal so you can go do it again. But, and this is a big but, there's a catch. Most lenders will only loan you about 70% of the property's new value after the rehab. This is precisely why buying at a discount is so critical. You have to create enough new equity to be able to get all of your cash back.
And that brings us to the final R, the one that changes everything, repeat. You take that cash you just pulled out and you go hunt for the next deal. This is what separates a one-off investment from a true wealth-building system. It's how you turn one chunk of money into a growing portfolio and start generating what feels like infinite returns.
Okay, so imagine this. You've totally crushed the first 4 steps. You got a great deal, the rehab was on budget, you've got a great tenant paying rent, and you just refinanced and got all your cash back out. You are teed up for a home run. So what's the #1 mistake that can completely wreck the whole strategy right at the finish line?
Seriously, think about it for a sec. The whole point of that last R is repeat. So what's the one thing you could do that's the exact opposite of repeating?
Yep, selling it. The single biggest mistake is breaking the chain. Instead of taking that cash and going again, investors get tempted by all that new equity they've created, and they cash out. They take what could be a long-term wealth machine and they turn it into a short-term paycheck. And that temptation to sell? It's often based on some really fuzzy math. As the source material points out, people sell and they don't consider all the costs. They get mesmerized by the big, shiny sale price, but they totally forget about all the things that get subtracted from it. To really see what a huge difference this makes, let's walk through a case study. We're going to look at the exact same property and see what happens down 2 different paths, the path of the flipper and the path of the long-term BRRRR investor. It really all comes down to mindset, doesn't it? Is your goal a quick, one-time payday, or are you trying to build a sustainable, long-term source of cash flow? The flipper is sprinting for a paycheck. The investor is building an asset.
Okay, so here's the flipper's math at first glance. They sell the property and see this huge, exciting number, an $80,000 profit. I mean, that looks fantastic on paper, right? This is the number that tempts people to sell, but it's not the real number.
And this is where that beautiful paper profit just starts to melt away. Look at these costs. You've got over 14 grand in interest on the short-term loan, another 3,200 in loan points, those are just fees to the lender, and then a massive $14,000 chunk for real estate commissions. That's over $32,000 in costs before we even mention taxes.
So here's the bottom line. After you subtract all those costs and you pay your capital gains taxes, that exciting $80,000 profit suddenly shrinks to just $26,880. That's the actual cash that goes into the flipper's pocket. It is a huge, huge difference.
This chart just lays out the choice perfectly. On one hand, the flipper gets a one-time check for about 27 grand. It's nice, but then it's over. The deal's done. On the other hand, the BRRRR investor now owns an asset that pays them $12,000 every single year for as long as they hold it.
And this is what the smart investor's portfolio now looks like. In this example, they're left with about $150,000 of their capital still in the deal, and it's generating a really solid 8% cash-on-cash return. That's $1,000 of passive income every single month. And on top of that, they still own the asset, which is probably going up in value. So we come right back to that fundamental choice. The flipper's path is all about chasing paychecks. The BRRRR investor's path is about building a wealth engine, a system that can churn out cash flow and build your net worth for years and years to come.
So I'll leave you with this final question to think about. Now that you've seen the real numbers, which would you rather have? A one-time payment that's gone once you spend it, or a lifetime of cash flow from an asset that you control? Thanks for joining us for this Explain.